Good afternoon and welcome to today's Premium Account ASX 50 short form market update for the 11th of June. Presenter today, myself, Leon Hine, current Managing Director of Global Equity Management. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Moving straight into a graph of the US market, the Dow Jones is really just been edging out small gains over the past few sessions. Some of the key economic data really is centred around slower growth in the US over the first half of this year and the necessity for the US earnings to pick up over the next sort of 5 to 6 months in order for the US market to reach its full annualised growth forecast rate, which is for around 9% earnings growth. On historical basis where PEs would be trading at normal levels, we'd expect the Dow Jones to be at slightly lower valuations than where it is at the moment, but as we spent a lot of time chatting about, the low bond yields globally is driving money into equities, and in particular chasing yield in equities, and valuations are running at slightly above historical PE averages. Now, we don't think that as a backdrop's largely going to change. I think from here we're most likely to see the market grind sideways until such time as we get this synchronised global GDP pickup. Over the course of the last week, we've seen further steps from the ECB to lower interest rates, implement a negative bank deposit rate to try to stimulate the Eurozone economy further, and in many respects that's the missing link that we've been chatting about for a number of months, that until the Eurozone really starts to fire, and that's beyond just Germany, we're sort of missing an integral part of the growth picture for the global economy. So at present the US market appears to be trending back towards its 3% annualised GDP rate, albeit it does require ongoing momentum in the months ahead in order for that to be met. The Japanese economy appears to be doing okay, and we're starting to obviously see the early signs of policy response in China to help underpin the Chinese market, and the caveat there clearly being the deteriorating housing and property market in general in China. But certainly when you look at the export volumes coming out of Australian ports, albeit spot metal prices have come off a bit, the actual volumes are holding up quite well. Before I move on to the ASX index, I'll just have a quick look at gold and chat a little bit about the global inflation picture. So we've seen concerns around deflation in the Eurozone, and that's partly why the ECB's taken the steps that they have. But in some parts of the rest of the global economy, there are the early signs of inflation starting to pick up. Now, that needs to be put in the context that the inflation numbers are coming off historical low levels or extreme low levels. So I think we're far from a picture where inflation really is a concern, but the gold market or the share market and gold market in general, looking ahead as a forward indicator, clearly gold's been telling us that there's no risk of deflation, of inflation I should say, in the economy over the last 12 months or so. But what we'd expect to see is, if inflation, as I say, a 2 to 3 year outlook was likely to become more of a issue for the global economy, and again, to put that in context, we're a long way from that at the moment. It's not until we were to probably see this synchronised global GDP pick up that really the inflation story would really start to become a factor. But it'll be interesting to watch over the next 12 to 24 months whether ultimately gold finds support here and trades back up towards around 1,500–1,600 an ounce. I think it's very hard to say where the final support level for gold will be, but I strongly suspect over the next 6 months we'll probably put in some sort of base for gold, and then ultimately it will trade higher in line with our broader macro view that in the coming years we will have more of a synchronised global GDP pickup as central bank policy starts to yield the results that it's intended, and ultimately we will see rising bond prices and some pickup in global inflation. But I think we are at least probably 18 months out from that becoming any sort of serious focal point for financial markets. Okay, moving on to the domestic market. The picture really hasn't changed too much here. We're trading at about 15 times forward earnings. Forward earnings growth of maybe somewhere to 5 to 7%. I think that's coming in at the bottom end of the range now that we're seeing commodity prices ratchet back. The prospect of BHP and Rio delivering 10% earnings growth like the market had expected, I think, is diminishing a little. So I think for the Australian market, it stays within our band where we're largely looking for it to spend the most part of probably through till September within this range as indicated on screen. I think we could see a pullback to around sort of 5,300. I would see that as support. Our market is well bidded at a sort of 4% plus dividend yield. On that note, let's have a look at the stocks that within the top 50 and a focus on which names are likely to deliver good buying opportunities. AGK is going through a sell-off at the moment, puts the stock on 4.5% dividend yield, about 14 times earnings and 10% earnings growth. It's a definite buy on the dip. I think it's in the early stage, or in the late stages, I should say, of this sell-off. Probably somewhere around $14.80. I'd expect it to find buying support, and we'd be happy to continue to add AGK to portfolios at or near that level. Asiano was on the radar. We've steered clear of it. I've indicated that there's better value elsewhere in the market. The stock's on a 2.5% yield. Yes, they are increasing their dividend payout ratio over the next year or two, but still I think there's better opportunities in the market. I'll only take a look at Asiano if this sell-off gets a lot deeper down to sub $5. Amcor, this is one of those defensive names we like. The stock's trading 15 times earnings, 4.5% dividend yield. We bought it at lower levels. We're selling the covered calls, a combination of the dividend and the call premium. We're driving 10 to 12% cash flow out of Amcor. Any pullback back down below 10.50, we're buyers of it again. I think this stock makes a lot of sense to keep exposure to in the current market. AMP, a little expensive up here, not doing it there at the moment. Unsure of earnings growth in AMP over the next 12 months. ANZ, we've seen cheaper funding coming through from the banks, and the stocks are bidded up today relative to the rest of the market that's being sold off. Underlying earnings growth for the banks, though, I think gone are the days of seeing the big increase in the dividend payout ratios and the big add-backs from the provisioned bad debts. I think most of that's behind us. It's really a story now about 2 to 3% top-line revenue, I should say around 4% top-line revenue growth, containing cost growth to around 2%, cheaper sourcing of funding. The banks maybe have another sort of 3 to 5% upside from here, and then I think we want to look at selling the covered calls over the banks. ASX, this is a definite buy on the dip down here. The stock's trading about 17 times earnings on a 5% dividend yield, but the prospect of corporate takeover activity in the years ahead underpins the downside for ASX. Market volumes are still very thin, so I'm not expecting too much in the way of earnings growth, but on a defensive 5% yield, we're definite buyers on the dip. We're selling the covered calls up at around $37.50, $38, and again driving about 10% cash flow out of ASX. Asiano, the market's still a little bit scared of the future funding requirements off the back of them expanding into the Pilbara. I think that's a buying opportunity. Anywhere on this sell-off, it makes sense to add to AZJ. We've largely sold the 525 calls now out into November. That's the second time we've collected call premium this year. So we've effectively generated around 10% return out of AZJ just in call premium. Plus we've got the 3 and a bit % dividend that we collect. So that's on annualised cash flow of around 13% that we're collecting out of AZJ. I think it finds support down here and trades back up to our target range of $5, and we'll continue to sell that 525 call into next year to keep driving cash flow out of AZJ. BHP, I think this is the only resource stock we're interested in. I think it's still a buy on the dip down here as we get into August, September. I'd expect to see BHP announce a share buyback, and I think the stock can trade higher. Not much in the way of earnings growth, as I said, with the lower spot iron ore prices now down at $90 a tonne. Brambles, now the Aussie dollar's performed well off the back of the slightly better economic data and generally a rotation of capital coming into the higher yielding currencies as we've seen interest rates cut there in the Eurozone. That's had some impact on some of these strong US dollar earners. Brambles is one of those. I've always maintained that Brambles is a little expensive up at around 950, 960, but any sell-off here is going to be shallow, so it's a buying opportunity. The stock's trading about 19 times earnings on a 3% dividend yield. Any pullback down here between sort of $9 and $9.50 is a buying opportunity. I think you still want exposure to these US dollar earners as a defensive play, as well as the fact that there's probably delivering one of the higher underlying earnings growth, about 8% forward earnings growth in Brambles over the next 12 months, so we want to continue owning that. CBAX marks the spot. We did own this at lower levels. When you add in that we delivered the stock at around $78 plus the call premium, we've effectively sort of sold out here at around $79.50. Looking for the stock to pull back again. If it does pull back coming into the August dividend, we'll look to jump back into CBA again on any pullback. To put into perspective the valuation, the stock's now on 4.6% dividend yield and trading almost 17 times earnings. So it's certainly expensive, but the probability of them disappointing on the earnings front is pretty low. So I don't think there's too many risks there, but it is expensive from historical standpoint. Coca-Cola trading down now at around 12 times earnings, just on about a 6% dividend yield. The stock's okay value down here. I don't think we can expect much in the way of earnings growth. Any rally back up to around $10, we want to sell the 10-20 calls into the end of the year, collect the upcoming dividend, collect the call premium, drives about 10% cash flow while we remain patient for a recovery to get underway there in Coca-Cola. Computershare expensive up here. I've chatted about this one. I do like the company. It should deliver 5 to 10% earnings growth, but 20 times earnings on a 2 and a bit % dividend yield. The stock's expensive. Keen to take a look at it, but ideally want to buy in at cheaper levels there. CSL, I think this is a good buying opportunity. It's only pulled back a few dollars from the recent high, but the company's still got a $200 to $300 million of their share buyback to go, and the stock price should be underpinned. One of the higher growth prospects in the market, 10% earnings growth over the next 12 months. Crown, I'd maintain that the stock was getting a little bit expensive. We did own it at lower levels. We've taken profit. We haven't moved back into Crown yet. As it pulls back down into our range here at around 15 to 15.50, happy to start to take a look at it. The stock's trading about 18 times earnings on a 2.5% dividend yield. They need to deliver about 10% earnings growth in the 12 months just to meet market expectation. Goodman Group within the property stock, I'll just touch on this one. It's not one we hold in portfolios, but just as a reference point for other property stocks, this business is going to grow earnings about 7%. It's trading 15 times earnings, and it's on a 4% dividend yield. So that's pretty low for the property space. When I'll give you the comparison as we roll through a few of the other names. So I did have a view that it was good value down here at around 450. I think it's starting to get pretty expensive up here, getting hard to justify owning property plays with a yield much below 4%. So we'd be looking for a pullback there. Now, to put that into context, GPT is one that we own from lower levels. We've let it rally up. We've sold the covered calls. We'll effectively be taking profit when you combine the call premium up here around $3.90. That puts the stock on about a 5.5% dividend yield, and it also has about 6 to 7% forward earnings growth. I think the stock will move sideways. Happy to stay focused on GPT, but we probably will be delivering that under the covered calls into that June period. But it's certainly been a good return considering we own it at much lower levels there. IAG not doing there at present, or in Iluka. IPL, continue to like this name. I think this is a buy on the dip down here. I think relative to the rest of the market, it presents some pretty reasonable value, trading about 12 times earnings, 4.5% dividend yield, and I think IPL can deliver 10% earnings growth, so at the top end of that sort of average earnings growth for the ASX 50 stocks. James Hardie, I think it's okay value here, reasonably well supported by yield, and obviously investors continuing to seek exposure to recovering US housing market. Lendlease is expensive. I chatted about that, trading up at around 15 times earnings on a 3% dividend yield. any pullback back down to around 12.80. We're keen buyers of Lendlease. On a forward outlook, the company should deliver 10% earnings growth. Macquarie getting a little expensive up here. The market's priced in 20 times earnings, which means that it delivered $3 of earnings in FY14. Out into FY15, it has to deliver $3.66, so that's 20% earnings growth. It's not going to have the benefit of the underlying addition from the sale of Sydney airports, so that would put the stock on 16 times next year earnings on a 4% dividend yield. I think a lot of the upside growth's already priced into Macquarie. I think on any substantial pullback in the market, and the probability is between now and probably September, October, we could have a 5% correction in the market. I think any sort of pullback in Macquarie, we're happy to take another look at as a buying opportunity, but at the top end of the range now. NAB of the banks, it obviously provides the lowest valuation and the highest yield. With the recovering UK economy and the housing market, the prospect of them spinning off their UK banking division, I think, should improve over the next 12 months. That would unlock some value and maybe see NAB trade closer in line with their Australian peers. But in general, the banking stocks all a similar situation, about 4% top-line revenue and about 2% cost growth. So forward earnings, I wouldn't expect to be much more than maybe 2 to 3% earnings growth in the banks. Dividends at the top end of the payout ratio. So I think likely to see further consolidation, and you need to be selling the covered calls to complement the returns. Newcrest, I just stop for a moment here on Newcrest and really reflect back to that graph at the beginning with where we see gold at present. Really hard to say whether the inflation concern picks up momentum sooner rather than later, and one of the reasons that would be is if the investment community really felt that the ECB's strategy was going to yield quicker economic growth than some market and participants may expect. If that was the case, then obviously that's going to lead to a more optimistic outlook towards inflation pickup, and would see a faster acceleration in the gold price. I think, at best we probably can just be confident that we're sitting somewhere near a support level in gold over the next 6 months, again based on that macro view that global synchronized GDP will occur as a result of central bank policy. And effectively, I think if we were to see gold trade back up to $1,400-1,500 an ounce, I think Newcrest could quite easily recapture sort of that $17 to $20 price range over the next 12 months. So we'll keep an eye on that picture. Origin, again, one of these concerns where their exposure or their acquisition of additional oil and gas plays into the Browse Basin may see them with the acquisition of Karoon Gas, may see Origin have to go back to the market in the form of a rights issue, raise capital, and we've seen the share price come off a little. We were always of the view that $15 was about fair value, and we'd been selling the covered calls up at $16 to sort of drive that additional cash flow. The stock's trading about 20 times earnings on a 3.5% dividend yield. I think as it gets back down to around this $14 range, it becomes okay value again, and I think it makes sense to try to own a little bit of Origin ahead of the upcoming rights issue, as it will be done at a discount, and I think that'll probably represent a low point or a support level in Origin. I think if we go out 12 to 18 months, Origin could be trading back up towards $16, $17. Oil Search, really at the top end of its valuation range. I think there's been a lot of optimism around the early shipping of gas out of Papua New Guinea, and Oil Search has been a beneficiary of that. We're expecting to see a strong uptick in earnings growth for Oil Search over the next 12 months, but I really think sort of most of that's priced in at the moment, so not doing anything further there in oil search. Rio, our preference is BHP, but I still think we're probably close to a bit of a capitulation in this iron ore trade at the moment, so looking for some support to develop in Rio and Fortescue in the months ahead, but that doesn't mean that we're adding those to portfolios. Again, our only resource exposure has been BHP and Woodside Petroleum. Stocklands, we've been long this stock. We've wanted to stay on the long side of Stocklands coming into the December dividend. I think it's at the top end of its valuation range now at $4. It compresses the yield back down to 5.5%. We're seeing a lot of money rotate into stocks ahead of their upcoming dividends. I'd expect post the dividend at the end of this month, probably Stocklands will settle back down around 375 to 380. I think that's support for the stock. So any opportunity to collect the dividends, sell the covered call, add to those returns, and then I think we'll see the stock settle around 380. The underlying business is growing earnings about 6%, paying a total annualized dividend of around 24 cents, so 12 cents will be the upcoming dividend. Sonic Healthcare, I think this is one that you want to add to portfolios on this sell-off. I think it'll find support down here at around $17. Coming into the August dividend, I'd expect the stock to rally back up towards around $18. That'll put the stock on roughly a 4% dividend yield, underlying earnings growth around 5%, but good defensive asset there. Santos, this is the best value oil and gas play in the Australian market within the top 50. We've been owners of it at $13.50. We're looking to take profit up at around $15. I think the stock will probably trade sideways around here. We'll revisit it again. I'm probably keen to keep exposure to Santos over the next sort of 6 to 18 months. But in general, at around $15, it starts to represent sort of full value short term. Sydney Airport, I think time to take some profit on some of these infrastructure plays. Likewise with Transurban, we've been long this name coming into the December dividend. Pay maybe around 19 cents dividend at the end of June, and then another one at the end of December. We own it at lower levels. We've sold the covered calls. I'd expect this stock to settle back down around $7.25, $7.30 post the June dividend. Telstra, I think this should be well supported coming into the August dividend at around 5.5%. I think it's probably still a cornerstone investment for portfolios. We're owning at these levels, selling covered calls up at around this sort of 5.50 level, driving that dividend yield from 5.5 up to sort of 10 to 12% cash flow. Toll, not much in the way of earnings growth here. I don't see the stock price performing really anything above sort of 5.50. Need to be selling calls up at around 5.75 to complement Toll. Westpac, in line with the general view on all the banks, I think well supported, getting a strong day today relative to the rest of the market as a result of these sort of cheaper funding costs that are starting to come through, and we've seen the first news flow of that with ANZ. But at around sort of $35, I think it's time to sell covered calls over Westpac. WDC, 4.5% yield, somewhere down here at 10.50 makes sense to add to it. Maybe that yield's pushing back up to around 4.7, 4.8%, but I think the stock can bounce sideways through here. We're selling the 11 sort of 50 to 11 or 11.25 to 11.50 calls, driving that yield from sort of 4.5 up to around 10%. I don't see WDC growing earnings much above 3%, so shouldn't do too much above that covered call level. Wesfarmers, with any luck, we see it, the US market sort of down 100 or 150 points in the next day or two, and any free capital that's available, I see Wesfarmers as a great buying opportunity down here at around $41. So it's a definite buy on the dip. Let it rally back up to around 43, sell the covered calls. The stock's expensive from a PE standpoint, but on a 4.7% dividend yield and about 5 to 8% underlying earnings growth, the company's sitting on a lot of cash from the sale of their insurance business to IAG, and it'll be interesting to see where they deploy that, but I think this sell-off's a buying opportunity in Wesfarmers. Likewise with Woolworths, any profit taking here. The stock's on a low yield of around 3.7. I think if we were to see it get back to around 4% dividend yield, so any sell-off back down to sort of around this $36 level, I think it's a buying opportunity as it'll be well supported again coming into the August dividend. Woodside Petroleum, 5.5% yield up here. Continued good production numbers coming through from Browse, and I would think that we're probably sitting close to resistance here short term in Woodside, but we continue to like BHP and Woodside. WRT, waiting for the final outcome of the spin-off of the WDC, Australian New Zealand assets. At around this level, the stock's trading about a 5.5% dividend yield, about 2 to 3% underlying earnings growth, and I think it's just sitting at reasonably fair value. But we still own Westfield Retail from lower levels. We've sold the covered calls. We'll collect the August dividend, and obviously we'll wait to see what the outcome of the split from WDC is as to ultimately whether WRT shareholders vote in favour of the merger with Centre or whether WDC in fact force the Westfield Retail into its own separate Australian property listing, which would probably be, I think, in some ways the worst outcome for Westfield Retail Trust shareholders. But given that we have a view that we're content owning the stock largely on the basis that it simply moves sideways, and we're benefiting from selling the covered calls and collecting the dividend, driving sort of 10 to 12% cash flow, I don't think the outcome materially impacts our investment returns for WRT. And then we have it. That's the wrap-up of the top 50. Thank you for listening in. And if you would like to know more about Investor Signal's managed broking account and how we can work in partnership with you to manage a portfolio of ASX 50 stocks with a derivative overlay, please contact me using the details on screen there.